All right, we mentioned it's a bit of a quiet Thursday in North American trading as investors have already digested what they felt like was the biggest economic story of the week, the inflation report in the U.S. yesterday, which had some investors cheering, as we are also continuing to navigate a bunch of earnings stories. But with stocks basically trading around record highs in North America, what does the future hold? Let's get perspective from Mike O'Rourke. He's Chief Market Strategist at JonesTrading, one of our regular guests. Mike, it's great to see you. And I do wonder, since you're watching the charts and looking at the fundamentals on a day-to-day basis, what stands out to you right now?
There's a lot of animal spirits in this market is the best way to describe it. Financial conditions remain easy. So you have a situation like we saw yesterday where we had an inline CPI report and the market took off. But it wasn't just the equity market that took off. Bitcoin took off. Of course, bonds rallied. Commodities rallied. So, that comes after 3 months of having hotter than expected readings. An inline number was enough to trigger markets into big rallies. But it still is a pretty inflationary number that doesn't shift the Fed's outlook that much.
And so for you, your view on how to play this market right now would be what?
I mean, I would still be cautious. I think what we're seeing here is the reason we're seeing inflation numbers not come in hotter than expected, or at least this one, is because we're seeing a slowdown in the economy simultaneously. So you had the retail sales number hit at the same time, and that was a disappointing number that also saw a downward revision to March. But it's not just retail sales. We've seen that's been the pattern. And all the numbers we've seen in the past 2-3 weeks is that you've seen the economy soften, and as such, you would expect inflation to come down with it. The problem is inflation is not coming down as quickly as you'd like it to if you're seeing the economy slow down. So one example is if you look at the Citigroup Economic Surprise Index, we're probably 1 or 2 bad numbers away from that index registering new 18-month lows, going through the 2023 lows. It just shows you that there is slowing in the economy, and investors should be, wary of both sides of the equation, not just, the inflation numbers, but where the economy is heading as well.
I always get a little nervous when Mike O'Rourke has these cautionary tales for us. So with the S&P 500 now up more than 11% this year, do you feel like we've hit our peak for U.S. stocks overall this year?
I mean, for the past couple of years, stocks have been driven by financial conditions. And that, this goes back to the Fed debate where Chairman Powell is constantly saying conditions are restrictive, or he's been saying it for a year now. And what you saw was GDP very strong in the second half of last year. You see financial markets very strong. I mean, there's all the fiscal stimulus in the United States economy. Now we're set to taper quantitative tapering, quantitative tightening. So you're looking at a situation where there's other factors at play here that aren't just the fundamentals of the environment. So it's hard to sit there and say this is the top. But what you can say is, stocks are more expensive relative to bonds than they have been any time this century. So that should something that should be a concern to investors. And even with bond yields, bonds rallying and yields dropping, stocks keep getting more expensive. So I think it's time to be a little more cautious. But as you know, I like the banks a lot. That's a group that's starting to break out to new highs, and it's the most attractive valuation within the S&P 500. So there are opportunities out there. I would just look for the safer plays where you have some valuation cushion in there.
Okay, let's stay on the financials for a sec. Yes, it is true. You have been a broken record on that call, but as you point out, there is some traction for financials. They've had better performance over the last month on the S&P 500 than the technology group. But what is it that would make you still bullish today? Just that they haven't grown into their valuations, in your opinion?
For sure. I mean, the banks within the S&P 500 trade about 11 times earnings, where the index is almost 25 times earnings. So there's a lot of upside there. And when you get to that point where investors finally decide to move away from just crowding into the Magnificent Seven, as you see flows rotate out of those names into the balance of the market, banks with those low valuations should be attractive. But again, when we eventually get those rate cuts, they'll be beneficiaries of that environment too. They'll be beneficiaries of any type of cyclical pickup in the economy when those rate cuts come. So I feel like you've priced in a lot of risk. Everyone's priced in, the commercial real estate risk and those factors, and they're great businesses and they continue to grow. And I think now that they're breaking out to new highs, investors are starting to recognize there's an opportunity here, and that will just generate more attention, more rotation.
Okay, before I let you go, I did want to talk about oil and energy stocks. Now, over the last month, we've seen crude steadily come down. Some people said that was the geopolitical risk premium steadily leaving the market. For the record, for some of the energy watchers that we speak with, a lot of them had circled, call it $80 US as a reasonable price, and we're there right now. So, but at the end of the day, energy stocks have lagged over the last month. It's a group who watch very closely here in Canada. It is a group that many people would say, perhaps like the bank stocks, is not fully reflecting of the value presented to investors. But when we're uncertain about the economy, and oil can go with the flow on that front too, I think it's always a tricky play. What's your take right now?
Well, I mean, it's interesting. Look at the U.S. stock market, new all-time highs. Everyone thinks everything's great, but you do have a group like the energy stocks lagging. If things are great, then energy stocks should close the gap to some extent, or the balance of the market should come in. Obviously, energy is a volatile sector. In addition to trading with the commodity, you have those concerns about economic slowdown. Every time recession fears emerge, oil comes off and the stocks get a little bit harder again, but you have that valuation cushion that they're the next cheapest area of the market after the banks, so that when they correct, I think you can buy those dips. Now, if we get this nirvana situation that the market, the broad tape's pricing right now with new all-time highs, then energy names are going to rebound later in the year and they're going to close that gap. If the economy does slow down materially, then the balance of the tape should come off more or correct more. And like I said, that valuation cushion will give energy investors some protection. So I mean, like I said, I think that's how you have to look at this tape, that there's going to be different opportunities, that you can't just be chasing the same 7 names that seem to be the most popular names in the market right now.
Mike, always appreciate